Is Amazon losing ground to Microsoft and Google in AI? Amazon's recent cloud revenue growth, while respectable, pales in comparison to the impressive strides made by Microsoft and Google. This disparity has sparked concerns about Amazon's standing in the generative AI arena, leading to a defensive posture from the tech giant. Amazon's stock took a hit on Friday, reflecting broader market sentiment and specific worries about its AI capabilities. But here's where it gets controversial. Is Amazon truly falling behind, or is this just a temporary setback? Amazon Web Services, AWS, reported a 17.5% increase in sales, reaching $30.78 billion in the second quarter. However, this growth rate is significantly lower than the 39% growth reported by Microsoft Azure and the 32% growth by Google Cloud. Amazon, despite being the largest provider of cloud infrastructure by market share, is facing intense competition from its rivals. This has reignited questions about Amazon's ability to compete effectively in the generative AI cloud workloads. Amazon stock dropped by 8.3% to close at $214.75, marking a challenging day for the overall stock market. The decline was influenced by a weak jobs report and new tariffs announced by President Donald Trump. The broader market sentiment was down, adding to the pressure on Amazon's stock. Amazon CEO Andy Jassy addressed these concerns during a conference call with analysts. He emphasized that the generative AI field is still in its early stages. Jassy believes that Amazon's cost advantages and extensive client base will provide long-term benefits. He noted that much of the current activity involves training AI models and getting generative AI applications into production. Jassy suggested that companies are not yet fully focused on ensuring these applications operate seamlessly with their existing data and infrastructure. The cloud battle is heating up, with Microsoft gaining momentum through its alliance with OpenAI, the creator of ChatGPT. Google's cloud technology remains popular among startups, while Oracle, once considered a laggard, has been securing significant AI contracts, including a major deal with OpenAI. Amazon, however, is not sitting idle. The company has invested $8 billion in Anthropic, a rival to OpenAI, and is developing custom chips to reduce AI processing costs for clients. AWS's Bedrock offering allows companies to build products by integrating their data into AI algorithms. Despite these efforts, Wall Street is eager to see more tangible results. Analysts like Scott Devitt from Wedbush expect concerns about AWS's growth rate and margins to persist in the coming quarters. Devitt believes that while the company's long-term opportunity remains intact, the perception of AWS as a laggard in the AI space could continue to weigh on its shares. Synergy Research Group estimates that Amazon captured 30% of the Q2 cloud infrastructure spending, compared to 20% for Microsoft and 13% for Google. This represents a slight decline from Amazon's 33% market share 2 years ago. The question on everyone's mind is when Amazon's cloud growth will accelerate. Many analysts are hoping for a boost in the second half of the year, but Jassy was cautious about committing to this timeline. He acknowledged that AWS has more demand than capacity, and that the company is investing heavily in building data centers. Amazon's capital expenditures in the second quarter amounted to $31.4 billion, with a similar spending pace expected for the rest of the year. Despite the setback, analysts remain largely bullish about Amazon. However, Thursday's report marked a significant challenge for a stock that had only recently recovered from a tariff-driven slump in the spring. Brad Erickson from RBC Capital Markets noted that the optics of AWS's underperformance and management's commentary will make it difficult to defend Amazon in the near term. He believes that the company will eventually restore investor faith in capitalizing on the AI opportunity, but this setback will take time to recover from. With Friday's slide, Amazon stock is essentially flat for 2025. Shares dipped below the 21-day moving average before finding support above the 50-day line. The broader market sentiment and specific concerns about Amazon's AI capabilities have created a challenging environment for the tech giant. And this is the part most people miss. While Amazon's current performance may be underwhelming, its long-term strategy and investments in AI could still position it as a leader in the field. The question remains, will Amazon's efforts in generative AI pay off in the long run? Or will it continue to lag behind its competitors? What do you think? Share your thoughts in the comments below. Amazon stock plunges 8% after earnings report. Amazon stock took a nosedive of 8% after its second quarter earnings report, leaving many investors scratching their heads. But here's where it gets controversial. Despite beating expectations on most fronts, the results weren't satisfactory enough to appease Wall Street. Shares closed down 8% on Friday, marking a year-to-date decline of roughly 2%. This performance is particularly surprising given the robust revenue and profit figures, steady retail growth, and a significant 23% jump in advertising sales. And this is the part most people miss. While the overall report was positive, weak profit guidance and underwhelming cloud growth overshadowed these achievements. One of the key takeaways from Amazon's earnings is the substantial investment in AI. The company reported spending $31.4 billion on capital expenses in the last quarter, with expectations for similar levels in the second half of the year. This brings the total projected spending to around $118 billion, up from the initial forecast of $100 billion. The bulk of this spending, which reached $83 billion last year, is aimed at enhancing tech infrastructure to meet the growing demand for AI. Not to be left behind, Amazon's competitors like Meta and Google are also making hefty investments in AI, with Meta forecasting $66 billion to $72 billion and Google $85 billion in capital spending for the year. The burning question for investors is when these investments will start translating into increased revenue or profits. During the conference call, Amazon CEO Andy Jassy indicated that the company's progress in AI has enhanced operational efficiency and business growth, though he didn't provide specific details. He also mentioned that generative AI is generating revenue for AWS at a rate of multiple billions of dollars annually. One example of how Amazon plans to monetize AI is Alexa Plus, an advanced version of its digital assistant, which launched in March. Available for $19.99 per month or $3 for Prime members, Alexa Plus could evolve into a subscription-based service with additional features. Jassy emphasized that AI development is still in its early stages. Another critical aspect highlighted in the earnings report is the competition in the cloud infrastructure market. While AWS continues to lead, it faces increasing pressure from Microsoft Azure and Google Cloud, which reported stronger growth rates. AWS saw 18% year-over-year revenue increase, slightly exceeding Wall Street's estimates, but lagging behind Microsoft and Google's respective 39% and 32% growth rates. During the call, analysts questioned why AWS isn't growing as rapidly as its rivals. Jassy addressed these concerns by pointing out that growth rates fluctuate and that AWS maintains a significantly larger market share. He also noted that AWS offers superior security compared to competitors, referencing a recent cyber attack on Microsoft's SharePoint software. Lastly, the earnings report provided some relief regarding the impact of tariffs on Amazon's operations. Initially, the company warned about potential cost increases due to a 145% tariff on Chinese imports. However, recent trade agreements have reduced the tariff rate to 30%. And Amazon's earnings suggest that the company has managed to navigate these changes better than anticipated. Sales in Amazon's online store exceeded forecasts, growing 11% year-over-year, and seller services revenue also surpassed expectations. The number of items sold across Amazon's platforms increased by 12%, indicating that consumer demand remains strong despite economic uncertainties. Amazon's third-quarter sales forecast, which predicts up to 13% growth, further supports the notion that the company has successfully absorbed the impact of tariffs. In conclusion, Amazon's earnings report presents a mixed picture, with strong performance in some areas and room for improvement in others. As investors continue to monitor Amazon's progress, particularly in AI and cloud computing, the company's ability to manage external challenges like tariffs will be crucial. What do you think? Are you optimistic or concerned about Amazon's future prospects? Share your thoughts in the comments.